Greetings and a warm welcome to the Manifested e-learning platform. Today we are going to begin with a new subject under the Certified Secretaries course. The subject is paper number 15, Governance and Compliance Audit. In this lesson, we will do an adumbration of the course outline. Then we will tackle the first topic. Now, the paper Governance and Compliance Audit has the following learning outcomes. A candidate who passes this paper should be able to, number one, identify the objectives and scope of governance and compliance audits. 2, design and implement a governance and compliance audit strategy. 3, prepare and interpret various governance and compliance audit reports. 4, analyze the various checklists for governance and compliance audits. 5, design self-evaluation tools. And lastly, draft audit report and audit opinion. These are 6 learning outcomes, and the unit description reads as follows: that this paper is intended to equip the candidate with knowledge, skills, and attitude that will enable him or her to effectively plan and conduct a governance and compliance audit. The syllabus is organized into 14 chapters. There are 14 chapters, namely: 1, basic concepts and elements in auditing; 2, governance and compliance risks; chapter 3, introduction to governance and compliance audit; chapter 4, legal, regulatory, and professional and ethical considerations; chapter 5, engagement and appointment; number 6, planning for governance and compliance audit; number 7, documentation and communication; number 8, conduct of governance and compliance audit; number 9, gathering audit evidence; number 10, reporting governance and compliance audit; number 11, implementing audit recommendations; number 12, post-governance and compliance audit; chapter 13, peer review mechanisms; and last chapter is governance awards in practice. So candidates will be going through each and every subtopic of this syllabus. I hope you do your part as I do my part. I expect you to attend all the lessons, to do the assignments, to ask questions, and over and above the video lectures, we have also available the study text and revision partners. The study text comprise comprehensive notes prepared as per the KASNEB syllabus. We also have the revision kits where we've answered KASNEB past paper questions, topically arranged. There is a section for the questions and a section for the answers, topically arranged for ease of revision. So we expect you to conduct continuous revision. That means that at the end of each topic, go to the revision partner, answer the questions that are topically arranged, then without looking at the answers at the back. Ensure you first of all attempt the questions, then you can refer to the answers having attempted the questions. When you do that, then you will not only be able to meet the course objectives, but you will also be preparing adequately for your examinations. We wish you all the best for those of you preparing for exams. We hope that as we start this training, you will enjoy the process. You will gather the necessary knowledge, skills, and expertise that will enable you to effectively plan and conduct governance and compliance auditing. The first basic concept is auditing. Now, candidates, in chapter 3, we will define governance and compliance audit. We will do a definition of governance and compliance audit. But for now, we want to get into the general meaning of the concepts, basic concepts. One such concept is auditing. What is an audit? or what is auditing? Auditing is a systematic, independent, and objective examination of an entity's systems, information, and practices against a criteria, against standards, laws, regulations, or best practices. That's the meaning of auditing. Auditing is a systematic, independent, and objective examination of an entity's operations, systems, information, and so on. So auditing, first of all, is a systematic, it's examination of an entity's systems, operations, information, and this information could be financial. Okay? It is a systematic, independent, and objective examination of an entity's operations, systems, information, and practices. Okay? This could include financial records. So we have operations, systems, information. We may even add processes. It could be processes, could be procedures, all right? Or it could also be practices and practices. So it is an examination, it is an assessment of an entity's information, processes, practices against criteria, against established criteria. It could be against criteria or standards or laws. An examination could be against criteria, it could be against standards, it could be against laws, it could be against regulations, it could be against best practices. And candidates governance and compliance audit is an example of an audit. We have very many types of audits. You have governance audits, compliance audits, financial audits, and so on. For example, for a financial audit, the auditor examines the financial records of an entity with the view of expressing an opinion as to whether the financial statements portray a true or fair view, or to give an opinion as to whether the organization has complied with an applicable financial reporting framework. That's a financial audit. We have a governance audit where the auditor examines the governance framework of an organization and expresses an opinion as to whether a company is complying with the corporate governance principles. It may be a compliance audit. Another example is a compliance audit. A compliance audit is an examination of an organization's adherence to laws, regulations, procedures, contractual arrangements, and so on. So generally, auditing is defined as a systematic, independent, and objective examination. That means that the assessment has to be systematic. This examination has to be systematic. The examination of these records has to also be independent. It also has to be objective. It is a systematic, independent, and objective process. And later on, we'll be looking into the meaning of independent. But now just understand, independent may mean that the one auditing should not be part of the operations. The one who is carrying out the operations cannot audit the same operations. The one who is maintaining the financial records should not be the one carrying out the independent examination. It has to be someone who is external, someone who is independent, someone who cannot be influenced by the decisions of the management. And that's why most external auditors are appointed by the shareholders. And they report to the shareholders so that they are not influenced or intimidated by the management. So that's the meaning of independent. It also has to be objective, meaning that the one carrying out the assessment should not be biased, should not be influenced by any other person or circumstance. And the scope of auditing candidates, you can see it covers a wide range of areas. It covers a wide range of areas. We have operations. An auditor may examine the operations. An auditor may examine an organization's systems. An auditor may also carry out an examination of information, including financial records, processes, and practices. So it covers a wide range. There are many different types of audits: financial audits, compliance audits, governance audits. So there are many types of audits that can be conducted. And that information includes financial records. That is the traditional and fundamental role of financial auditing. And you can see the purpose also extends to adherence to various benchmarks. That's why we have benchmarks like standards, laws, regulations. Now, that's where compliance audit comes in. A compliance auditor will examine adherence of an organization to laws, regulations, internal policies, standards, corporate governance, and so on. Is the organization obeying the rules? Is it playing by the rules? That's the role of a compliance auditor. Okay? So this is a general definition that encompasses the full spectrum of modern auditing, from ensuring the accuracy and fairness of companies' financial statements to assessing its compliance with the environmental laws, the effectiveness of its IT security systems. It could be corporate governance framework, and so on. So that's the meaning of auditing. Now let's move to the second concept in the syllabus, which is assessment. Assessment. From the word assess. Now, in a broader context, assessment refers to the process of evaluating or appraising something. To assess is to evaluate. To assess is to appraise something. And in the context of auditing, assessment then means or refers to the various stages or activities such as risk assessment. I've said assessment generally means evaluation. Okay? But from the context of auditing, assessment may refer to the various stages in auditing, like risk assessment. That means identifying and analyzing risks of material misstatements in the financial statements. It may also mean control assessment. It may mean control assessment. That's another activity, which means evaluating the effectiveness of an organization's internal control system or internal controls. Assessment also may refer to performance assessment. Performance assessment. Because while not directly an audit function, an audit might involve assessing certain financial or operational aspects that contribute to the overall performance. You understand? Yes, so that's the meaning of assessment. To assess is to evaluate, and that's the role of an auditor. To assess is to examine, is to evaluate, is to appraise. That's the meaning of the word assessment. The third concept is monitoring. Monitoring. This is 1, 2, 3. Monitoring, from the word monitor. Now, monitoring in an auditing concept refers to the ongoing or periodic evaluation of the design and operating effectiveness of internal controls by management to ensure that they are functioning as intended. The management candidates of a company has the responsibility to ensure that the organization is running in such a way that will contribute to the achievement of an organization's objectives. It is the role of the management to ensure that there are proper internal controls to ensure that the assets of an organization are safeguarded. That's why the organization, the management has the responsibility to monitor. Okay? It has the responsibility to monitor periodically and continuously the design and the operating effectiveness of internal controls. The management has to check, for example, if there are controls over inventories. An organization will have controls over cash. It will have controls over, say, purchasing system. There has to be controls. Who does the purchasing? Who authorizes purchasing? Those are controls. There ought to also be segregation of duties when it comes to the purchasing cycle. The one who makes requisition should not be the one ordering for supplies. There has to be segregation of duty. Segregation of duty is an example of a control. So the management has to continuously ensure that such duties are segregated. The management has to ensure that, for example, if there are inventories will have physical controls. The store, for example, or the warehouse has to be physically secured. The management should continuously follow up and monitor and find out if such internal controls are operating and they are also effective. So monitoring refers to the ongoing and periodic evaluation of the design and the operating effectiveness of internal controls by the management to ensure that these controls are functioning as intended. So that monitoring is the role of the management. For an auditor, the auditor has to understand an entity's monitoring activities, which is crucial because it provides evidence about the reliability of an entity's financial reporting and the effectiveness of its internal control system. An auditor comes in, but the role of the auditor is not to monitor the effectiveness of internal controls. No, the auditor is supposed to check and find out if the internal control system is operating as intended. Because if it is operating as intended, then the auditor can rely on the financial statements that are provided. But if the internal control system is weak, then the auditor cannot place reliance on the assertions made in the financial statements. You understand? So monitoring is performed by management. It may be performed by internal audit department or even external parties. So that's the meaning of monitoring. Ongoing and periodic evaluation. It is the ongoing, refers to the ongoing evaluation of the company's internal controls by management to ensure that the internal controls are functioning as intended, to ensure the internal controls, the design and operations are as planned. Then the fourth concept is assurance engagement. Number 4. Is it assurance engagement? Yes, number 4, assurance engagement. What is an assurance engagement? Now, an assurance engagement is an arrangement or an engagement in which a practitioner expresses a conclusion designed to enhance the degree of confidence of the intended users, other than the responsible party, about the outcome of the evaluation or measurement of a subject matter against a criteria. Assurance. To assure, from the word assure. To assure means to provide confidence, to give confidence. And such an example of an assurance engagement is a financial audit, or a governance audit, or compliance audit. Compliance audit is an assurance engagement. A governance audit is an assurance engagement. A financial audit is another example of an assurance engagement where a practitioner who is a professional, it could be a financial auditor or a governance auditor, who expresses an opinion, and the idea here is to enhance the confidence of the users of the subject matter. I give an example of a financial audit. In a financial audit, candidates, the shareholders of a company, they appoint the management to run the company on their behalf, because they may not be in a position, or they may not have, shareholders may not have the skills necessary to run an organization. So they appoint agents. They appoint the management to run the affairs of the company on their behalf. This management has a statutory responsibility to prepare financial statements. They are legally mandated to prepare financial statements like the income statement, like the balance sheet, and so on. Now, these shareholders may appoint auditors. These auditors are appointed by the shareholders to express an opinion on the validity of the financial statements. So this auditor is a practitioner. The auditor is a professional. He is independently hired by the management. And the purpose is for them to examine, to carry out an audit, to systematically, independently, and objectively examine the entity's financial records against established criteria. The financial statements as prepared by the management are required to be prepared in line with an acceptable financial reporting framework. The management is mandated to prepare financial statements in accordance with international financial reporting standards. You understand? So when the auditor examines these financial statements, the auditor checks to determine whether the management has prepared these financial statements in line with the international financial reporting standards, and then reports to the shareholders. In the audit report, the auditor will indicate that having examined the financial statements of the company, it is our opinion financial statements have been prepared in line with international financial reporting standards. The process that is what we are referring to as assurance. The auditor assures the shareholders that the management has prepared the financial statements in line with an applicable financial reporting framework. So an assurance engagement is an engagement or an arrangement where a practitioner like an auditor expresses a conclusion designed to enhance a degree of confidence. So by stating that the financial statements prepared in accordance with an applicable framework, what the auditor does is giving assurance, confidence, providing confidence to the shareholders that the financial statements portray a true and fair view. For example, if the inventories, as indicated in the financial statements, is say 10 million, when the auditor gives a positive conclusion, then the shareholders have the confidence it is true, as reported by management, that the value of inventory is 10 million. That's what is meant by assurance engagement. And the most common type of assurance engagement is the financial statement audit, which I have explained here. But it can also include reviews of financial statements. It can also include examinations of prospective financial information or reports on internal controls. A compliance auditor may also give an assurance on the internal controls. It may examine the internal controls and express an opinion as to whether the internal controls are effective, are operating as intended. The auditor may also give a negative opinion. The auditor can state in a financial audit that having examined the financial statements of the company, it is our opinion that the management has not prepared the financial statements in accordance with an applicable financial reporting framework. That is not enhancing the degree of confidence, but is expressing an opinion as the things are, so that the users, shareholders is just the one user. There are many other users. There are many other parties who rely on these audited financial statements so that they can make their own informed decisions. That's why the bank, before the bank gives a company a loan, the bank would require to have a look at the audited financial statements for the last 3 years. That's the meaning of assurance engagement. Now we'll take it a bit further, and maybe for the purpose of understanding, an assurance engagement has 3 parties. The key elements in an assurance engagement include 3-party relationship. Elements here include 3-party relationship. Elements of an assurance engagement. 1, 3. It is a 3-party relationship. An assurance engagement is a 3-party relationship. There are 3 parties. The first party is the practitioner, the auditor. The second party is the responsible party, which is the management that prepares the financial statements. The third party is the intended user. It could be the shareholders. These are the ones who rely on the audited financial statements. So an assurance engagement has 3 parties. The practitioner, who is the auditor, the responsible party, who is the management that prepares the financial statements, and the intended users, who are the shareholders. That's the first element. Then we have subject matter. The subject matter could be what is being assured. It could be the financial statements, it could be internal controls, it could be the governance framework, can be anything. Can be prospective financial information, it could be internal controls. That's the subject matter. What the auditor examines is what you are referring to as the subject matter. Then the third element is criteria. Criteria is the benchmark used to evaluate or measure the subject matter. In an audit of financial records, the criteria is the International Financial Reporting Framework, the International Financial Reporting Standards. If it is the internal controls, the criteria could be COSO framework. So the auditor examines the financial statements against a criteria. It could be International Financial Reporting Standards. The auditor checks, for example, the elements in the financial statement, say properties, plant and equipment, or the fixed assets. Now, candidates, fixed assets are, there is a way in which the International Financial Reporting Standards expect or demand that fixed assets be recorded. There are standards on how to record fixed assets, and the management ought to stick to these standards, and the standard is the criteria. So the auditor comes in to check if the company has, for example, prepared or recorded and recognized fixed assets in accordance with these standards. So the criteria is the benchmark. You understand? And that's what we stated here. An audit is an examination of these records and information against an established criteria. So the auditor looks at the what is being presented, then he compares with what is what is expected to be done. What is the established criteria? What are the standards? Do you understand? So criteria is the third element of an assurance engagement. Then there is evidence. Evidence. Now, evidence is information gathered by the practitioner to support the conclusion. In the process of examining the financial statements or the internal controls or the governance framework, the auditor gathers evidence which he then uses to express an opinion as to whether the company has complied or not. It is the information gathered by the practitioner to support the conclusion. Then we have assurance report. Assurance report. After gathering this evidence, then the auditor has to prepare an assurance report. It is the written report containing the practitioner's conclusion. Within this report, you find the practitioner's opinion. So an assurance engagement has these 4 or 5 elements. It could be the financial audit, it could be governance audit or compliance audit or any other type of audit. It will have the 5 elements. It is, number 1, a 3-party relationship. Number 2, it has subject matter. There is criteria, evidence, and assurance report. That's the meaning of assurance engagement. And we give an example of the audit of financial statements of an entity. That is an assurance engagement. Now let's move to the next element, which is number 5, non-assurance engagement. 5, non-assurance engagement. You recall assurance engagement, we said this is where the practitioner expresses a conclusion designed to do what? To enhance degree of confidence. In a non-assurance engagement, candidates is an engagement where the practitioner does not express a conclusion designed to enhance the degree of confidence. It's just the opposite. Here, the practitioner expresses an opinion to enhance the degree of confidence. Here, the practitioner does not express an opinion to enhance the degree of confidence. It is the opposite. The practitioner does not express a conclusion. The practitioner opinion to enhance the degree of confidence. The practitioner in an assurance engagement does not express an opinion to enhance the degree of confidence, all right, to the users of the subject matter. An example of an assurance engagement is a compilation engagement. Compilation engagement. Compilation. Now, there are times when the practitioner may be called upon by the management to help the management compile financial statements in line with the an applicable financial reporting framework. Just compiling, preparing financial statements from client provided information. You may be called as a practitioner to help the company to compile the financial statements in a form that is required by international financial reporting standards. When that happens, the practitioner is not required to provide any assurance. All right? Another example is tax advisory services. Tax advisory services. When a practitioner provides tax advisory services, the practitioner does not give any confidence. Okay? Here, in providing tax services, the practitioner may provide tax planning or compliance advice. A conclusion is not given, just advice. The practitioner does not express any opinion to enhance the degree of confidence. Consultancy services. Consultancy services. When a practitioner provides consultancy services, like offering business advice or solutions, the practitioner does not express an opinion to enhance the degree of confidence. We have agreed upon procedures. Agreed upon procedures. This means performing specific procedures agreed upon with the client and reporting factual findings without expressing an opinion or conclusion. So that is the meaning of non-assurance engagement. I've defined it. I've given examples of such engagements. That is number 5. Number 6, the 6th basic concept in auditing here is reasonable assurance. Reasonable assurance. Reasonable assurance. Now, candidates assurance, which is providing a degree of confidence, comes in levels. We have high level assurance, then there is low level assurance. So reasonable assurance is a high level of assurance. It is a high but not absolute. It is just high of assurance. In fact, it's the highest level of assurance. It is a high level of assurance. In an audit of financial statements, reasonable assurance means that the auditor has obtained sufficient appropriate evidence to reduce audit risk, okay, to an acceptably low level. It implies that the auditor has conducted the audit with the due professional care, applying auditing standards, and has gathered enough evidence to form a positive conclusion. However, it does not guarantee that the financial statements are 100% accurate or free from all misstatements due to the inherent limitations of an audit.